Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Julie Hyman. Let's get to the three things you need to know today. First up, U.S. stock futures little change this morning after closing out flat in Monday's trading session. Investors in wait-and-see mode ahead of the Fed's meeting in Jackson Hole, where traders will search for clues on the central bank's plans for interest rates. Plus, Home Depot out with its earnings results. The world's largest home improvement company posting disappointing same-store sales growth. The key metric grew by just 1% year over year. That's below what Wall Street was hoping for. Home Depot's seen sales slow over the past 2 years as Americans put off buying new homes or take on renovations that require financing. An additional headwind for the company, the president's tariffs. And Intel shares getting a boost as SoftBank announces a $2 billion investment in the company. The U.S. chipmaker will issue new stock to the Japanese investment firm for the sizable stake. That investment comes as the White House weighs a reported 10% stake in the chipmaker just 2 weeks after President Trump called for the immediate resignation of its CEO. Let's get a check-in on stock futures right now. We're seeing a mixed picture here, really a stalling out close to record highs. We've been seeing a drift over the past few sessions. Today, we're seeing some strength in the Dow on a relative basis. Futures pointing to a gain of about 0.5% at the open. NASDAQ futures falling by the same amount. And S&P futures hovering right there in the middle. Let's dig into our top stories of the day. Futures searching for direction as the S&P 500's record run stalls, and Home Depot maintaining its full-year forecast despite missing second quarter earnings estimates. Plus, investors awaiting a key speech from Fed Chair Jerome Powell in Jackson Hole this week. Joining me now, senior reporters Brooke DePalma and Josh Schaefer. Josh, going to start with you here. As we have this stall, there are perhaps reasons to think that engine will be revving up again, maybe even as soon as later this week.
Yeah, Julie, interesting. So we're waiting for Jackson Hole, right? Of course, that's not coming until Friday, where we're going to hear from Fed Chair Jerome Powell. But there was some interesting data from Data Track Research published this morning. They were sending this out to clients, highlighting that the S&P 500 actually typically floats higher over the 2-week period when Jackson Hole is. So that would be this week and then also next week when you sort of would have the markets reacting to what we hear on Friday. So on an average basis, going back to 2010, the S&P 500 has added almost 1% across that period. Under Fed Chair Jerome Powell, excluding 2022, which is, of course, we had a bear market in 2022, so do whatever with what the exclusions are in these stats, right? But the S&P 500 has actually risen 2.4% during Powell-Jackson Hole weeks and the week after. So Data Track essentially arguing that there is a chance, if history bears out, and it's Powell's last Jackson Hole meeting, if he does something the market likes to some extent, which would at this point probably be talk about rate cuts, right, then perhaps you see more record highs in the stock market because, yes, we haven't really gone anywhere. So we're still pretty much sitting right near a record high for the benchmark index. And, of course, the question is, will we float higher or not?
That's always the question. The answer is usually yes,
right.
But we'll see what happens this time around. Brooke, you flagged some interesting commentary this morning from Ed Yardeni, his characterization of Powell was interesting.
Yeah, Ed Yardeni saying in a note this morning that rather than Federal Reserve Chair Jerome Powell taking a dovish or a hawkish tone, he'll be just about in the middle with more of an owl tone. He said striking a wait-and-see approach, which is what we've seen Fed Chair Jerome Powell take in the past, reiterating that the Federal Reserve is data-dependent. And Ed Yardeni expects to hear that from Powell yet again, that they are data-dependent. And we're waiting on some key data points coming out at the end of August and in September ahead of that next FOMC meeting in mid-September. And those three key data points that we're still waiting on that we'll likely hear from Powell this Friday reiterate is that PCE index, where that report will be out August 29th. We're also waiting on August's CPI report set to come out on September 11th. And that key employment report, that's going to come out September 5th. Now, what Yardeni went on to say is that their hunch is that inflation will be hotter than expected and payrolls will be better than expected. And if that does happen, then he said that the FOMC should vote to pass on a rate cut with perhaps 3 instead of 2 that we've heard in the past, dissenters. But what exactly we will expect to hear, according to Ed Yardeni, once again, is that owl tone, that wait and see approach that we've heard Federal Chair Jerome Powell say in the past.
I would pay good money to hear Jerome Powell do kind of an owl hoot or something at that press conference.
In Jackson Hole, hey.
True, there's probably some real owls there. Reportedly there are bats, although they're not making any noise, at least none that we can hear. Okay, let's talk about what happens if and when there are rate cuts and what effect that could have on the market. Josh, you're looking into some research on that front this morning.
Yeah, so the team over at Bank of America, Savita Subramanian, highlighting that she thinks that the start of the rate cutting cycle, or the restarting of this rate cutting cycle, right, the resuming of those cuts, could sort of make a larger shift in the market away from large caps. If you go back over the last 10 years, Bank of America was looking at, you really just had a large cap bias in this market since 2015. And she was comparing it to, if you go back to the early 2000s and you go back to the end of one of the last times that we had large caps outperforming this much, that of course was the end of the dot-com bubble. What happened for early 2000s was small caps were a great trade, value was a great trade, and so she's sort of making the case that that could play out. On the other hand, you look at what other folks are saying about the small cap trade right now. I mean, the Russell 2000's up 6% in August, over the 4% that the S&P 500's up. So you're starting to see this play out in the market, and the question is, will it continue? Will we finally get a new high for the Russell 2000, which has not hit a new high during this bull market? And the problem with that trade, strategists argue, the team over at UBS was making this case on a call I was on yesterday, is the path to Goldilocks for small caps is just so narrow right now. We're talking about why the Fed would cut. Is the Fed going to cut for good reasons? Or is the Fed going to cut because the labor market is weakening? And if the Fed is cutting because the labor market is weakening and we get a lot of rate cuts this year, that is not a good case for small caps. So the debate on why the Fed cuts and how much they cut remains super important for if the small cap trade actually continues to outperform. Julie, of course, we have been debating this and hearing about this for, it feels like, 3 years now, if small caps are ever going to join this rally. So it hasn't happened yet.
It has not, and we'll see if that is indeed the thing that finally unlocks it. As we know, rate cuts are important for not just small caps, important for almost everything. And falling squarely into that category is Home Depot, and the implications for when people do work on their homes, what kind of work, et cetera. Brooke, what did we hear from Home Depot last quarter?
Yeah, right now the street is reacting. Keep in mind that this report missed on revenue, missed on earnings, and missed on same-store sales growth. They also reiterated their guidance. But right now, shares are moving higher in this pre-market trading hours. And what exactly has investors excited is this potential that consumers are either going to just get used to higher interest rates or that we'll see lower interest rates on the horizon. Other commentary that has Wall Street excited right now, the CEO just now saying on the call that customers are engaging more broadly in smaller home improvement projects. He went on to say that performance across the business was the strongest that they've seen in 2 years. And so perhaps that customers getting used to or hoping for lower interest rates is top of mind. Also keep in mind some commentary that we also got out this morning is that May and June same-store sales growth was largely muted, but they did see a huge improvement in July. We know that these summer months are key game changers for Home Depot as consumers really lean into home improvement projects, and of course that may be backyard projects as well.
Yes, we'll see how that all plays out. And we're going to be talking about those themes of rate cuts and also home equity lines and all of that actually throughout the day. So thanks so much, Brooke, Josh, appreciate it. Japanese conglomerate SoftBank will make a $2 billion investment into Intel, the two companies announcing Monday. The investment will make SoftBank among Intel's top 5 shareholders, per FactSet. Joining me now to discuss, senior tech reporter Dan Howley. So interesting here to see SoftBank make this move. And there are a lot of questions about what that investment gets it and what all of this means for Intel.
Yeah, it's tough to say at this point. Intel needs a heck of a lot more than $2 billion to kind of right its ship. So it is something, but it's not going to be kind of the panacea that maybe some folks want it to be. It does give SoftBank enough of a stake to obviously have them interested in continuing to see Intel move forward with its turnaround plan. But, investors are excited about it. The stock is up in pre-market. This also follows those reports that the U.S. government was going to take a 10% stake in the company. That had sent shares down yesterday after they had gone up on the initial reports that the government was looking to take a stake into Intel last week. So it's kind of been a total roller coaster ride for the stock over the past few days as investors kind of digest this news of, is the government going to take a stake? How big of a stake is it going to take? Oh, and now SoftBank has officially taken a stake. It's all part of this kind of ongoing turnaround plan that Lip-Bu Tan is trying to kind of usher forward, that started under former CEO Pat Gelsinger, but obviously he was ousted as the board didn't really like where the plan was at the time.
Yeah, exactly. So there, as I said, there's still a lot of questions about where Intel goes going forward. But I also want to ask you about a development for Nvidia. There's a report that it is developing a new AI chip for the Chinese market to comply with export restrictions, and one that reportedly would be less advanced than the most advanced chips, but more advanced than the H20 that it currently sells there.
Yeah, this is from Reuters, basically saying that it's a Blackwell-based chip. Now, Blackwell is its current available top of the line. They don't offer a version of Blackwell in China. It's just banned to be shipped there. The H is based on the H20 that they have is based on their older Hopper technology, hence the H. But this would be a lower end version of the Blackwell. This, according to the report, it would still offer some of the capabilities, including NVLink, which is their high speed connectivity. That's part of the H20 though, as well. We heard President Trump kind of talk about this when he had mentioned that the government would be taking a 15% fee, basically, from every chip sold to China from Nvidia, and AMD. He had said that they were, looking into having its Blackwell chip sent over to China as a kind of modified version, and this could be that chip, according to this report. So, it would potentially boost sales for Nvidia over there. Obviously, the H20, not the most powerful chip in the world, but it does get you into that Nvidia ecosystem, and a lot of developers like building on Nvidia's ecosystem, and there's a lot of apps that and services that run directly on it. So this would be a big benefit for Nvidia if they're able to get this up and off the ground. Although there is a lot of pushback from folks in Washington outside of the Trump administration. Democrats have pushed back, and there's been some Republicans who have kind of been concerned about the U.S. continuing to ship chips.
Right. So, well, I'm sure there'll be more headlines on this at some point as this develops. Dan, thank you. Appreciate it. Coming up, investors are pricing in rate cuts in September, but will the Fed give the market what it wants? We'll discuss next. Don't go anywhere. Now time for some of today's trending tickers. We are watching Amer Sports, ARM, and Nexstar. First up, Amer Sports boosting its full-year revenue and earnings per share guidance after topping forecasts for its second quarter. Analysts did note that the company's Omnicomp sales for its technical apparel unit, which houses its Arc'teryx brand, fell just short of estimates in the second quarter. The company CEO was upbeat on the earnings call, saying the company remains confident in its ability to navigate tariffs and macro uncertainties in the near term. Next up, semiconductor tech company ARM has hired a former Amazon AI exec to develop its own chips. That's according to a report from Reuters. ARM traditionally designs the core architecture and instruction sets for processors, which are then licensed to customers like Apple and Nvidia. But it's recently been boosting its in-house team to build complete chips. Other recent hires include a former HPE executive and a Qualcomm engineer. And finally, Nexstar Media will acquire rival local TV owner Tegna for $6.2 billion. It's a deal that will reshape the local news landscape. Once the merger closes, Nexstar will own more than 260 stations, reaching 80% of all U.S. households. That's well above the previous 39% limit on station ownership that was in place from the Federal Communications Commission for decades. In announcing this deal, Nexstar's CEO credited the Trump administration's deregulation efforts, stating the merger will allow local broadcasters to compete more effectively with legacy media companies. As always, you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Well, investors are gearing up for the Federal Reserve's annual Jackson Hole Symposium. The big focus will be Friday when Chair Jerome Powell delivers remarks on the U.S. economy. What can we expect of volatility ahead as the market fully prices in a September cut? Joining us now, Kathy Jones, Charles Schwab Chief Fixed Income Strategist. Kathy, it's great to see you. We were just talking about a new animal that needs to come into the discussion about hawks and doves, and that is the owl, which Ed Yardeni says Jay Powell will want to sort of look around and wait and see rather than being more definitive on Friday. What do you think?
Well, Julie, I think it was Christine Lagarde who introduced the concept of being an owl, being wise about decision making and thoughtful, and I'm sure that Powell will try to be that. The Fed is really stuck in a hard place, as they have been for quite some time. They're challenged on both sides of their current mandate. So we're arguably at full employment, but the underlying conditions in the job market are deteriorating. And yet, we're pretty far above the 2% inflation target. So as much as we do anticipate that the next step will be a rate cut probably in September, I think Fed Chair Powell has to just go very slowly about this, not overdo it, because the markets have already priced it in, and with inflation higher than it needs to be and trending up, with more tariffs on the way to possibly boost it further, he has got to be very careful about that and convey the right message. So it's going to be a tough message for him to make owlish.
Yeah, we've all been talking about, okay, what's the signal he's going to send? But as you point out in your note, you have to pay attention with the theme of the conference is too, because there could be some interesting nuance coming out from discussions there. And the theme of the conference is labor markets and transition, demographics, productivity, and macroeconomic policy. So with that focus on labor markets, what should investors be watching for beyond the sort of headline, will they or won't they?
Yeah, well, the Fed is due to discuss its new policy framework. They've been studying and reviewing this for quite some time, and they're due to talk about it now. I think it's unrealistic to expect the Fed to change its inflation target, even though we're stuck closer to 3% than 2%. I think they will move away from the flexible average inflation targeting, because that was in place at a time when they thought that policy was constraining full employment. Now, we've been pretty close to full employment for a while, so I don't think that they want to focus on that anymore. But they're going to have to deal with the fact that the labor force is shrinking through aging population, which they mentioned demographics, through policies on immigration, deportations. We've got a shrinking labor force size. And that is running up against an economy that wants to grow and creating potential inflation while also slowing the economy. So we have a policy mix that's really tough here, and they have to come up with a framework to deal with that. I don't know what that framework's going to be, but I think it'll be I think the papers presented, it'll be really interesting conversation around that, because it's not just happening here. Demographics are causing the labor forces to shrink worldwide as the populations age. And this is something a lot of central banks are dealing with right now.
And does that mean also when we look to the next jobs report that is before the next Fed rate decision, that the balance should shift? We sort of are split between the unemployment rate typically and the actual non-farm payrolls number. But because the dynamics you're talking about affect the unemployment rate, should we be paying more attention to those non-farm payroll numbers?
Oh, I think so. I think the Fed, having focused on inflation now for quite some time, will probably focus more heavily on the labor market, because things are deteriorating there, and they don't want to miss on both sides. And we've seen some troubling signals, not only the decline in the pace of growth in non-farm payrolls, but also youth unemployment is up, unemployment amongst minorities is up. Very difficult compared to a few years ago for college graduates to enter the labor force. So those dynamics are really important to the Fed, because they portend slower growth down the road. So I do think focusing on the labor market is going to be where we'll get the signals about what the Fed's going to do.
So Kathy, let's bring this all back to your world, the world of fixed income. Where do you think yield should be given, this sort of confusing backdrop for the Fed? And what do you think folks should be doing in terms of treasuries right now, in terms of that strategy?
Yeah, I think that the Fed is likely to cut rates of about 50 basis points over the next couple of months, and that short-term rates come down. They have said that their current policy is restrictive, so cutting 50 basis points will still leave you with a positive real rate of interest, which I think is appropriate. Unless we're in recession, we don't want negative real rates. So short-term rates, intermediate-term rates probably come down, around 50 basis points or so. But as you move out the yield curve, I think they come down less. We get more steepening of the yield curve because the inflation dynamic is still not under control, and because we have a rising level of debt to be financed. So a steeper yield curve means that, 10-year yields could come down maybe 25, 30 basis points, while short-term rates can come down 50 or more. And I think that that's kind of what we'll see. For investors, I still think this is an opportunity to buy treasuries or, high-quality bonds. I'd be very concerned about lower credit quality bonds, but still think this is an opportunity because the cycle of cutting is just beginning, and that should bring rates down over time. And you have a chance to buy intermediate term high quality bonds at these yields without getting a lot of reinvestment risk as short rates come down, but also without too much interest rate risk and exposure for volatility down the road.
Gotcha, Kathy. Good to see you. Thank you so much. Coming up on Yahoo Finance Opening Bid, executive editor Brian Sozzi is with us now. Soz, what do you got coming up?
Julie, like your zoo chat there. You didn't tell me what you labeled me, tiger, a bear, or I don't know, something, oh my. I know you get that one. But look, we're going to dive into Intel. That company's crumbling continues. Also going to drill into Home Depot. I caught up with the CFO on how that quarter went and some of the things he saw towards the end of the quarter, Julie.
I'm going to meditate. I'm going to ruminate on what your spirit animal is, and I'll get back to you.
Yeah, just slack it to me. I sit near you in the office, too.
All right, sounds good. All right, that does it for Morning Brief. Much more ahead on Yahoo Finance.